Good afternoon, traders and investors. Will back here with another one, coming to you with a Sunday night video, guys. And it's that time of the week again where we go over the top 5 options plays for the upcoming week. Hopefully all of you had a very nice weekend so far. So in today's video, guys, keep in mind that all the options I'm going to give to you are for selling options, more specifically for selling put options as part of the larger wheel strategy that we like to run on the channel. It's been a very successful strategy for us running this on the YouTube channel publicly for the last 2 years. In 2024, we wrapped up with over 60% annualized ROI. In 2023, we had over 75% annualized ROI. It's a very successful strategy so long as you respect the rules. A very easy strategy to run, whether you're a beginner, intermediate, or even advanced investor. So in today's video, guys, we have to take a look at a few things together. Number one, we're going to set the tone for the week. How do we look on the technicals? How do we also look in terms of volatility catalysts from macroeconomic news releases that we have this week? And how can it possibly influence our trading? That's going to be number one. Number two, we're going to go through some of the strategy rules that I like to look for when shopping for short put options to generate some very nice passive income for my portfolio. And lastly, we're going to get into the top 5 options plays, of course, the juicy stuff. And as per usual, I do have a ton of bonus plays for you, so make sure you stick around until the end of the video. I'll probably throw about 10, 15 plus plays at you today, guys, so there will be something for everybody in today's video. So without further ado, let us jump right into the action. So in terms of the context for the week, guys, we cannot forget the context that we are currently in terms of the market narrative. Now, I did a huge video yesterday, and if you haven't watched the first 15-20 minutes, I highly recommend it. We went through the entire pros and the cons list and the volatility catalyst that we have on the horizon for the week. And in conclusion, what you need to understand is that we have a lot of volatility catalysts, and I will be playing this market a little bit more conservative than I have been in the last 2-3 months, just because of all the possible volatility and understanding the fact that the markets can indeed drop lower. So I'm still cautiously optimistic, as I wrote down here in the conclusions, but patient and very selective. I am not going to overload on the long side when the market has bounces. The last thing you want to do is buy things at the top and then see further declines, and you do not want to get trapped at poor levels in trades. So the emphasis this week and in the next 2-3 weeks as we move through these volatility catalysts is going to be an emphasis on extremely high quality companies, the best of the best of the best in their respective industries, guys. It is the best we can do to protect ourselves to the downside is being very selective, being very patient with our trades, and waiting for our desired levels to show up. So in terms of the technical analysis for the SPY, as I was describing in the last couple days of videos, well, unfortunately now we have done something we have not done in a very long time. The SPY is now in weekly downtrends. The QQs as well are now also in weekly downtrends. We have not had weekly downtrends on the Qs since the month of March and April, when the very same inflation concerns were arising in the markets. As well, on the SPY, we have not had weekly downtrends. Well, in April, we didn't have them there. The last time we had weekly downtrends on the SPY was fall of 2023, when you had similar inflation and higher for longer interest rate concerns. So we will be buying the dip on these markets because a lot of the technical factors right now are pointing to the fact that we are getting into some fairly fearful conditions, but still do not think that this is the bottom. The market can also always go lower. So even though we are trying to buy the dip in a fear environment, we still have to be very selective with our companies and very relatively conservative with our strike prices, because we assume that the markets can go lower. As I've been saying for January, guys, hope for the best, but you have to be expecting the worst right now that we are into weekly downtrending scenarios and even into monthly consolidation for the SPY and monthly consolidation as well for the QQs. Monthly consolidation is perfectly normal, guys, but the last thing you want to do is get trapped up here and go for, 3, 4, 5 percentage points more down on the Qs and the SPY, and then you are out of buying power, you're trapped, and you just feel terrible. So you want to spend the money on these dips, but do not spend it all at once, guys. We want to be patient with this. We want to be buying into the market progressively over the next 3 weeks because there is not a shortage of volatility catalysts. In terms of the catalysts that point to oversold, I will point you towards the percentage of stocks above their 20-day moving average. We are very low levels right now at 26% of stocks above their 20-day EMA. Now, as you can see, this is usually a fearful environment for the market. Usually when we come down into these low levels, we do eventually get some form of bounce, but do not get it twisted. We can indeed go lower, as you have seen over the last 2 years of data. 26 is low, but you can dip into the low 20s and even teens in the percentage of stocks above their 50-day moving average. These are all just short-term indications of momentum and just shows that the overall market is broadly down. You can see here, percentage of stocks above their 50-day, 28%. Can we go lower? Yes. Just take a look at the last 2 years of data and you will see that even though we are low, we can go lower. Percentage of stocks above their 200-day moving average, a longer form trend for the market. Well, we are now arguably at the lowest point that we've seen all throughout 2024 and of course early 2025. You would have to go back all the way to the fall sell-off of 2023, reminding you of the SPY weekly downtrends back then, right? You would have to go all the way back here to find some data that shows that there was as much fear in the market. So although we are coming down, it can always go lower. And that's the moral of the story, guys. I like the levels that the markets are coming down to, but there's still a lot of names that are relatively high in relation to their recent price action, especially some of the big tech names. So if the big tech names have another 1 to 2 weeks of decline, your indexes and the broad market will be pulling back quite considerably. Fear and greed index is now reading fear, so we do want to start buying the dips, acknowledging the fact that it can indeed go lower. A lot of the momentum indications, guys, extreme fear, stock price strength in terms of 52-week highs and lows on the New York Stock Exchange. That is extreme fear because, of course, guys, the heat map constantly looks like this on a one-day relative, on a one-week relative, not so bad. But look at the last month. Nothing really has been spared by the market. The market is overall weak, not just a few names here and there, but overall weak. So you know when that is the case, it may take a little bit of time to turn around. You can't just snap your finger and put in one big daily green candle and turn around this momentum in one single day. So please do keep that in mind. I'm a big fan of buying the dips right now, but hopefully I've been able to explain that we have to buy the dips slowly and cautiously, right? In terms of index seasonality, I'll remind you as well that January is a very mixed month for the markets, and culmination of which is the end of January as well. So the last thing you want to do is get trapped in positions right now when you know that you potentially have a bunch of remaining volatility catalysts in the market, right? This week we get CPI, PPI, and December retail sales. As you can see from this economic calendar right here, Tuesday, PPI, inflation gauge, Wednesday, CPI, another inflation gauge, and then on Thursday, the retail sales. Couple that with the fact that we also have the start to the bank earnings. And we know that the environment right now is higher rates for longer. What does this impact? The most important metric for all banks, which is their net interest income. So if ever they give severely underwhelming guidance because they believe rates will be higher for longer, and as such, they have to revise their guidance that they gave last Q4, which was net interest income was supposed to come up because we were supposed to get more rate cuts, right? But now they may taper back their guidance, and that could hurt the financials industry. So if you're playing any banks, be cautious. But not only the banks, this can also affect some of your favorite fintech plays out there, such as SoFi, Square, and PayPal alike. So that is why you will not see some of those names on my list for this week because of those volatility events. Thereafter, next week, we get Trump inauguration and GDP numbers, Jan 20th to 24th. And the end of the month, guys, 27th to the 31st, all of big tech earnings, a possible Jerome Powell pause, and another PCE inflation read. So tons of volatility on the horizon for everybody, guys, which is why I'm saying we are not out of the woods just yet. So any positions that we put on, we should fully acknowledge that it could be a very bumpy and volatile month of January, especially towards the tail end, which would put a lot more emphasis on this graph of seasonality. And then you can see as we move into February and March, the markets kind of smooth themselves out and find the spring rally thereafter at the midpoint in March. So Jan and Feb could be a little bit volatile. So as such, we are going to take the most logical and the safest and most conservative trades on the highest quality companies. Make sense? Perfect. So I did a little bit of a longer introduction, guys, because these are the times in the markets that matter the most, right? You know there's a big head and shoulders on the SPY. We know we're in weekly downtrending cycles, and we know we're possibly into monthly consolidation. I do want to buy the fear, but we'll buy the fear slowly. So that's enough of that, guys. Now, in terms of the put strategy rules, right? So these rules, guys, in a market environment where you have a lot of volatility, you want to respect these rules. Treat it as a business, guys. Do you ever wonder why I always wear shirts when I'm making these videos? I can wear a t-shirt, I can wear a hoodie like everybody else, right? But even when I'm trading on my own in my house Monday through Friday, I'm always wearing a nice shirt, a nice pair of dress pants as well, because it reminds me of the time where I used to work at the bank and manage a lot of trades for very high net worth clients, and you want to be focused on a business mindset. Don't just start trading willy-nilly, and hope is not a strategy, I'll remind you as well, right? You want to treat this as a business. Be professional about your trades. Try and be an algorithm. Remove the emotion and trade things logically and respect the strategy rules, guys. The rules will save you over the long run. I can guarantee you that. So in terms of writing puts, guys, what exactly is writing puts? Well, when the market is dipping, we want to be buying the dip. Now, instead of just buying shares right here, I would rather write short puts under the market, which acts as a buy limit order that pays you. So selling a put, in essence, is essentially a buy limit order that does pay you. Let's say for all intents and purposes, I wanted to buy NVIDIA on the dip, and I want to buy NVIDIA at 130 or less. So let's say there's two ways of doing that. I can either place a buy limit order for 100 shares of NVIDIA at 130, but in the event NVIDIA doesn't come down to 130 this week, and the stock just kind of stays above or rallies, I'm not going to get any money whatsoever, right? It's my buy limit order is just going to stay there. I'm not going to get filled. The market's going to rally and I make no money. That is where short puts come into play, guys. These are buy limit orders that pay you whether or not they get filled. So take a look here. If I write the NVIDIA 130 put, I get to collect $120 for doing so. If NVIDIA closes above 130 by Friday, I just get to keep all the $120 in my pocket and nothing else happens. If it ends below 130, I still get to pocket the $120 of premium, but at least I get to reduce my cost basis by that $120. So it's a buy limit order that pays you some premium, allowing you to further reduce your average cost. This is one of my favorite strategies, guys, when we're into dips and we want to buy the market lower, but we're not too sure if it's going to get there, right? So that being said, the put wheels is to act as a buy limit order under the market. Now, all of these rules are going to put the risk of assignment on, or the non-risk of assignment rather, on your side. All of them are trying to replicate a strategy that doesn't assign you that often, right? Even though you want to buy these companies, we want to just be collecting premium as much as possible, right? So number one that you want to do is build a watch list and filter these companies by red. These should be companies that you know a lot about and that you have high conviction in, or at least you know how they move in terms of trading. Every Monday, Tuesday, Wednesday morning, I am filtering this entire watch list by red, and I'm only interested in the companies that are red on the day. When I go through the rest of the rules, this will make sense. Number one, we want to be targeting high quality and high conviction companies only, guys, especially in this landscape. You do not want to get caught with a company that you know little about and that is not high conviction for you. If you get assigned a stock and it keeps moving down, you would rather that be a high quality company that you trust, right? Because if not, you're going to have to open your portfolio every day, see the position at a red, and wonder what the heck you're doing in the trade in the first place. So please, in this market environment, guys, rule number one, it gets overlooked. This is where a lot of people go wrong trading the wheel, guys, is they go for the technicals only and they forget the fact that they're supposed to look for high quality companies, right? They'll try to write some short puts on Etsy just because Etsy has a decent support level, right? Decent support level down here, then they get trapped and then it keeps going down and they wonder what the hell they're still doing in the trade, right? So do not let this happen to you, guys. High quality, high conviction companies only, and the rest of the rules should make you be able to find those as well. So let's move into it, shall we? Monthly uptrends and long-term ranges. So you want to find companies that are in monthly uptrends or at least long-term ranges. A long-term range and a monthly uptrend could be something like a Microsoft, right? We know that Microsoft usually tends to trend up with the rest of the markets as displayed by this long-term, 5-10 year chart, right? So monthly uptrend is clear as day, but Microsoft is also right now in a long-standing range. You put it on the weekly and you'll see a 1 year range at this point. So when we're targeting the lower end of support on a stock that usually is in a large monthly uptrend, we usually get a very high success ratio on those stocks, right? So that is rule number 2 for that reason. Rule number 3, I keep forgetting where my rules are, my bad, guys. So monthly uptrend or a long-term range. Number 3, no earnings this week, guys, right? So we know that earnings can be very volatile. A stock may have very good numbers, but can go down 5, 10, 15%. You guys have seen that all last year. So if you want to be safe, rather than sorry, do not play any stocks that have earnings this week, guys. It's just not worth it, in my opinion. Number 4, we want to be trading stocks that are in a support area or an area of breakout retest. So I keep bringing up this chart all the time. I'll explain the 2 trades. A support area is like we saw on Microsoft. It's a long-term range, and you want to be targeting the bottom end of the support range because the bulls usually are going to have your back. Fairly simple, right? In terms of the breakout retest trade, well, you can see a range resistance high right here, and eventually when the bulls break out of it on the weekly time frame, you can usually get what's called as a retest and then run. This retest area is usually a high probability trade for the markets, at least for a little bit of bounce continuation. So that's the type of trades that I'm looking for, either a support area or a breakout retest, something like you're seeing on Apple right now, break out of the range and now possibly retesting the range. Could offer a little bit of a bounce, but especially in these markets, you do not want to overstay your welcome, right? So all the trades that you see me take are going to be one of those two. They're either going to be a long-term support range or a breakout retest. Now, number 5, we want to be writing at or lower than the expected move, guys. What does this mean? If you do not know what the expected move of a company is, you can come to this website right here, barchart.com. Just type it into Google, bar chart, NVIDIA, expected move, or whatever stock you want to take. It'll bring you to this page. Now, for this week, for some reason, they're not giving the expected move on the chart for 117, January 17th, but you can find them down here if ever they're not displayed on the chart correctly, right? So here you can see I have the expected move for Coca-Cola, and you can see the expected move for this week is 59.9 to the lower end. We want to be writing puts below that area, guys. Why? Well, because this is Wall Street's probabilities of a stock being able to move up or down in a given percentage through the given week. If you can find some short puts below the expected move, it stands to argue you usually have a little bit of mean reversion midway through the week. If the stock just comes down into the expected move, very aggressive on a Monday or Tuesday, usually it does tend to have a bounce and bring it back into the confines of the expected move. So that is why we're always looking to write stocks below the expected move, increases our odds of not being assigned. Thereafter, we want to be writing on a red or flat day. So it stands to argue, it goes with the previous point, if we want to be writing below the expected move, well, if a stock is massively green on Monday or Tuesday, guys, it's not going to give us any premium down here, so we cannot chase them, right? You need a stock to be red so you can be able to write below the expected move. Once again, putting all the odds on your side of not being assigned, so you will never see me write any put options in a given week on a stock that is green. That's just chasing the market, and I'm not down for it. Now, before last, this is the ROI, guys. We want to be writing, this is your take-home pay per week, right? So we want to be writing puts providing us 0.5 to 0.75% in weekly ROI. What does that mean, guys? Well, very simply, if you go to the options chain right here, I want to see at least 0.5% on my desired strike. If you want to know how to do this in your head, I know a lot of people like to use delta and whatnot, but the problem with delta, guys, is whether you're looking at NVIDIA's options chain, right? A 20 or 30 delta can be a lot further away than it can necessarily be on a stock like Coca-Cola, right? So rather than have to fumble between different deltas and looking which delta corresponds to the strike price that you want and stuff like that, it's a lot of work, right? So the easiest way to do it, guys, is use the 0.5% rule. It's in the last 6-7 years of me trading this strategy, it is the sweet spot between a low risk of assignment and a very healthy ROI per year. If we're always getting between 0.5% and 0.75% per week without any compounding, we should be making at least 26 to 30% annualized, which is over 2 times the usual performance of the S&P per year. That is very good. That is the baseline minimum. So what does the 0.5% rule mean? It just means that when you're looking at a stock's price, you want to find 0.5% on the bid here for writing short puts. A very easy way to do that in your head, guys, is just divide the strike price by 2, and you want to see that in cent increments on the bid. So half of 130 should be 65. We can see that, whoa, it's paying way too much premium, so we may want to go a little bit further to reduce our risk of assignment. Take a look down here, the 127s, right? Half of 127 is roughly, I don't know, like 63, 64, and you can see here we're getting over that 69 cents, and below that 126, it's just not paying enough. So the 127s right now would be the sweet spot for NVIDIA. Very easy way to go through a ton of options chains really quickly, guys. Just do half of the stock price in cent increments, and then you know if you're getting paid enough for that option, right? So that is the 0.5% rule. And now lastly, we want to set a take profit order at 90% of the contract value. This is just to be capital efficient, guys. If you snipe the bottoms on Monday or Tuesday, you get very good entries, and then by Tuesday afternoon or Wednesday morning, the contract is 90% profitable. Why would you keep it until Friday for the extra 10%? It does not make sense. You may as well just close the trade and go shopping for a new trade that provides you with almost full premium. We're just trying to be capital efficient and use our capital the best, right? And now lastly, if we get assigned, because I told you these short puts, selling puts to open, is a buy limit strategy under the market. Now, in the event we have to buy the shares and get assigned, how do we get out of those shares? That is when you write covered calls. Covered calls are a sell limit order. So this is a buy limit order, and this is going to be the sell limit order to get out of the trade. Now, for the covered calls, same rules apply. When you get assigned, if I have to buy NVIDIA stock at 130 because I get assigned this week, let's say, and the next week after, what I'll be looking to do is write covered calls at 130, and I'll be going to the options chain and finding the same thing. Can I find 0.5% to 1% in covered call premium for that week? If so, it does respect my strategy. So that is how we play the wheel. This is the portion to get in to the trade. This is the portion to get out. So 0.5% to 1% in weekly premium. And lastly, we want to be writing covered calls at the assigned strike price or one strike higher. The only time you'll ever find me writing one strike price higher than my assignment strike is in the event I get assigned on Friday and then Monday, the stock just massively gaps up from my assignment level. Then I might write 1 or 2 strikes higher, try to pocket a little bit more of that share appreciation. But I would say, guys, of all the times that I get assigned, which is not that often, 95% plus of the time, I'm always writing at my assigned strike price. So hopefully those rules were clear. Those are all the rules. If you want a more detailed version of those rules, there's a 30-minute video that I filmed on the channel about a year ago at this time. I'll leave it down below in the description. 30-minute video. It covers the rules a lot more in detail. And obviously it's a free video. It's on the YouTube channel, right? So those are the strategy rules. So now I've given you the context for the week and the strategy rules. So we should be sitting pretty now to benefit from some of these stock declines. So let's get into the top 5 options plays, shall we? So top 5 options plays, guys. Number 1, we're going to start it off with a banger. And that is, of course, going to be NVIDIA, which we were just talking about. Now, NVIDIA, the reason I like the stock, well, there's many reasons that I like the stock. Number 1 is their industry leader status in terms of them providing data center GPUs, but also the software that they've been working on, as displayed in their CES presentation this past week, was extremely good for the markets, guys. Very productive GPUs for retail right now, but the software that they're working on, especially in relation to AI, will possibly give them a new vertical, a new revenue stream moving past 2026 and 2027 when the data center revenue starts peaking a little bit, right? That being said, NVIDIA right now, the valuation is not so bad. At 135, it's probably sitting somewhere around a 1.85 peg, 1.8 peg, which is really not that bad when you consider the growth of this company and the outlook for this given year, which is going to be extremely bullish for NVIDIA. That being said, it has come down with the rest of the market, which is presenting us a very juicy buying opportunity in my humble opinion. Now, the expected move for the week is 130.45. Good thing for us, that is right above an area of support that we're looking at. 130 down to 125. Now, because the market is so volatile and also because of the fact that TSMC earnings are on Thursday, I personally believe that TSMC is going to smash it out of the ballpark, right? So because of this earnings volatility, I want to be playing one of the most solid companies in all of semiconductors right now. I can tell you there's so many other semiconductor plays that are on nice dips right now that I'd be interested in running the wheel on. AMD is one of them. Micron is another one of them, LRCX, ON Semiconductor. There's tons of names, but for this week specifically in this market environment, I'm focusing on the highest quality name out of them all, which is going to be NVIDIA. I would play TSM, but they have earnings, right? And I'm not looking to play a company that has earnings. So that being said, 130.45 is your expected move. Let's go shopping if we can find any premium below that expected move. And as I was showing you guys, you can find the 126s way below the expected move. However, it gets even better. If NVIDIA has a red Monday or Tuesday with the rest of the markets and brings us down into 133, 132, even 131, what do you think that's going to do, guys? It's going to free up some strikes even lower. Think the low 120s. So at a first glance, my favorite strikes for NVIDIA this entire week are probably going to be 126 all the way down to 120. Depending on the size of the move down, you want to be dynamic with your strike prices. Just because I say the 126 looks good, it's not set in stone. If NVIDIA drops, you want to be going as low as possible on this options chain while still finding your 0.5% rule. That is how we play this market very safely, guys. So at a first glance, as I said, 126, but I'm willing to go down all the way to 120, the next area of support and the the 200 daily EMA. In the event NVIDIA drops Monday or Tuesday, that will free up the lower 120s, and that is where I truly want to DCA into more of this stock. So that is stock number one. Stock number two is going to be another extremely high quality company, arguably an industry leader. Well, not arguably, they are an industry leader, them and CrowdStrike. And I'm talking about Palo Alto Networks, which just had their stock split just a few short weeks ago. Now, Palo Alto has pretty much been straight down. No news for the company specifically, just overall market weakness. They, at the peak, were down about 18-19% and are coming into a very nice area of support, which is known as the 167 down to roughly 161. You can see it's this pocket of support right here. We do have the long-standing monthly uptrends. If I put it on the monthly, you'll see beautiful, beautiful, beautiful monthly uptrend. All we're looking for now is a monthly higher low for possible further trend continuation. The guidance for this company in 2025 is extremely strong. They should be a very hot player in 2025 because with all of these AI companies, all of them and other software as a service companies do still require cybersecurity, and the total expanding addressable market of cybersecurity is huge. And two of the dominant players in this, of course, are Palo Alto and CrowdStrike. As of right now, Palo Alto is providing a very nice opportunity, tapping into the 12 EMA on the monthly, which they have held arguably since early 2023, and tapping into the 50 weekly EMA, which the company has also held since that same time period of early 2023. So the trends are nice. We have a nice 20% decline here. We are daily oversold conditions. So all of that is known as what I call confluence. We have a confluence of factors to where this stock should be in a good dip buying opportunity. That being said, the expected move for the week is 167.85. Let's go shopping together to see, can we find anything good at 167 or below? So let's pull up Palo Alto Networks together, shall we? So Palo Alto Networks, we're gonna have a look, and we want below, of course, the 167.85. So keeping that in mind, the 167.50s right now, you can see are paying over 0.5%, right? Half of 170 roughly should be about 85, let's call it. So in that case, we're getting more than 85 cents right here, which is good. So for me, depending on the move on Palo Alto Networks on Monday or Tuesday, if we dip a little bit further, guys, two strikes will be available. The 167.5s are already available, but the 165s may be freed up as well. Both of those strikes are in our support range, but true to these markets and the volatility, guys, I want to be getting as deep as possible. So I wouldn't mind writing the 167.5s, but if you ask me truly, I would prefer writing the 165s. And obviously, if Palo Alto and the markets have a very bad day Monday and PANW goes down, let's say 2-3% down below 170, what do you think that's going to do, guys? It's going to free up the 162.50s. So depending on the size of the move down this week, for me, it's between these three strikes, 167 down to about 162. Be dynamic with it. Try to get as low as possible to ensure that you're getting the best possible price into daily oversold conditions. So if you get assigned and the bounce does happen, you have a good probability of getting out of that trade very rapidly. That's stock number two. Stock number three is going to be another one of my favorite plays right now. Now, yes, although this one has lost the monthly uptrend, we are in a monthly downtrend right now. We cannot deny that e.l.f. Beauty is pretty much taking over the entire beauty industry. And the beauty industry right now is a lot more resilient in the face of a possible consumer slowdown or a recession because, let's be quite frank, right? People do not stop doing their makeup when there's a recession or not. What do? They trade down from expensive products to cheaper products without trying to forfeit any quality. That is where e.l.f. Beauty comes in. That is their entire business model. They offer very high quality products at a fraction of the price. How can they do that? Well, because they have no physical stores, guys. This company is able to keep their costs low because they drive most of their sales through their online business model. Their marketing strategy is a lot better than other companies such as L'Oreal, Estee Lauder, because their marketing strategy is entirely online. As such, they've built a tremendous following on social media, and they've built an extremely loyal customer base, especially in terms of millennials and Gen Z, which are arguably going to be the target consumer of the future. So e.l.f. Beauty's future looks very bright, not only for the long-term future, but also for 2025, guys. Take a look here. Expansion of EPS is gorgeous, and expansion of revenue is equally as gorgeous. This company is looking very good, and they have traded down a lot since their all-time highs. So I do want to be buying the dips down here. That being said, you know me, I want to get the best possible price. Expected move for the week is 117.04. So let's go shopping below, see if we can find anything below on e.l.f. Beauty below that 117 mark, shall we? So let's pull up the options chain for e.l.f. Beauty for the week. And you will see 0.5% rule, guys. My eyes directly went to 114. Why? Half of 114, right, is roughly, let's call it 55-ish, 57-ish, and already we're finding better premium at 114 than not. Even at the 113s, guys, you can find the required premium roughly 55-60 cents, right? So that is well below the expected move, below 117, and is coming into the larger support area, which I like playing, which is closer and closer to 110. So I'm not saying Elf Beauty cannot go lower. It can definitely go lower, guys. And if we take a look at the pattern right now, it's kind of looking like a head and shoulders. Same thing as the SPY, same thing as Bitcoin. A lot of charts are showing this pattern. So in the event we get some follow through Monday or Tuesday and we drop down 4, 5, 6%, you guys know Elf Beauty can move 4, 5, 6% in a daily candle. If that does happen and we pull down into the lower 120s, 119, 118, I will be able to find some premium, probably 110 and below, guys. 110 down to 105. So at a first glance, I like Elf Beauty at 113, 114. However, if we decline Monday or Tuesday and I can find anything below 110, I'm going to go with that trade, guys. I like that support area. I love the valuation down there, and it's going to be a very nice level to pick up a solid company, in my opinion. Now, that is it for trade number 3. Trade number 4 is a trade that I'm in right now personally. And we're going to be talking about the SPY itself. So I'm going to be using the ticker SPLG, but we know that the SPY has been fairly weak, and we also know that this is one of the easiest trades in the entire market, guys. If you're not comfortable buying into the S&P 500, I can't help you at that point. However, when this trade does come up, usually it's a very nice trade, a very successful trade as well. And I'm going to be using the 26 EMA with SPLG. This is not a 2 times leverage the SPY or nothing like that. It is just another ETF that mimics the SPY performance, replicates exactly what the S&P holds, no leverage whatsoever. This is just a cheaper way of playing the S&P, because if you were to try to write short puts on the SPY, well, you'd have to pay like $58,000 for 100 shares, right? So if you want to keep it cheaper, we use SPLG, and I will be targeting the 26 EMA. You can say the context of a bull market, even last fall, or fall 2023 rather, it was a very good opportunity to be buying. Can it dip below? Sure. But is it a good buying opportunity to be buying the SPY at the 26 EMA? Yes. Can it go lower? Yes. And we will dollar cost average, but I want to start a little bit of a swing trade here on the S&P, and I will be using SPLG as a proxy. You can see in this portfolio, I already have one position, the 68 short puts for the Friday close. These are monthly contracts, so you only have this week or middle of February. So now that we're coming into the last week of this contract, I want to be using it because if I get assigned, I will have no problem riding the S&P through the volatility and writing covered calls for the month of February. That being said, you can see I have an average cost here of 35 cents, which respects my required 0.5% minimum. They're actually more expensive right now, so you can even get better pricing on this one than me. The expected move for the SPY or SPLG this week down here is 67.16, below the gap fill after Trump and coming into the bottoming process of the previous area of support. I mean, I have all the indicators on the SPY, but I haven't drawn them here. This is a decent area of support. And as I said, it lines up with that 26 EMA as well. So taking a look, the expected move, 67.16 on the SPY, going to be volatile. There's going to be a lot of volatility catalysts that can make the S&P move into that location. So I want to be striking when the iron is hot and playing this one a little bit more. Well, I'm not playing this one conservatively, but the trade itself is more conservative. We're literally trading the SPY, guys, right? So keeping that in mind, let's have a look at SPLG and see, can we find some premium? Now, keep in mind, it is the S&P, so you're not going to find the same amount of margin of safety or premium as some of the tech stocks, right? That being said, you can find some good ones. As you can see, the 68s where I am are currently trading for about 50 cents, well above our 0.5% rule. It's closer to the 0.75% rule. However, it is above the expected move. Now, I don't mind, especially for the SPY, taking it a little bit above the expected move. Why? Because if I get assigned here at 68 with a 50-cent credit, my break even becomes 67.50, very close to support, very close to the expected move. I don't mind. However, if you want to be truly patient and below the expected move, if the SPY comes down Monday morning for some follow through as well, comes down low 68s, high 67s, that is going to free up the $67 strike on the SPLG. What you want to see here is at least 35 cents for this trade to be worth it for you. Even if you see 30 cents, guys, if you're a little bit under, it doesn't matter. I would still open up that trade. So that is one of the trades that I'm looking at this week. Another possible trade as well, if you're interested, is a similar one like QQQM. This is just a smaller version of the QQQ. It holds the exact same thing. The allocations are the same. Once again, it's just another ETF that replicates the QQQ, and it's called QQQM. No leverage, nothing like that. Straight Qs, right? The QQQM expected move is down here, 204.66. If you can find some lower 200s on the Qs, not a bad look here, guys. That's the top of the month of August, pretty much, down into the 26 EMA. And you can see, even though sometimes we do come below the 26 EMA through corrective actions in the markets, usually it's a good time to start buying the QQQs if that's something that interests you. So QQQM below 205, I'm a big fan for this week. Same thing like SPLG, monthly contracts only. So it's either this week or middle of February. Take your pick, guys. Those are the two of the ones that I'm looking at for this week. A little bit more conservative, right? They're just index plays as a whole, as opposed to my traditional stock-specific plays. Now, trade number 5 is also going to be one that's a bit more defensive, which is Coca-Cola. I've brought this one up frequently on the channel because, let's be honest, guys, it is one of the highest quality companies in the entire world, and the stock has been on a very big dip recently, down about 16% from the local highs. That being said, we are coming into monthly areas of support. All of these, guys, are large support. I'm talking about $60 all the way down to roughly 57, 58. Lines up with the 26 EMA, and this is a monthly breakout retest. I know the retest is taking a very long time, but just understand who's in control here, and who is in control long-term is definitely the long-term bulls. So this is a company that I do not mind, especially amidst all the volatility. I do not mind being assigned shares of Coca-Cola, guys. Such a solid company. It's one of the ones that if I get assigned, guys, I just brush it off my shoulder. I don't even mind. It's the same as buying the SPY or the QQQ, right? You get assigned at Palantir at the wrong level at the tops, or Tesla at the wrong level at the tops, it'll make you sweat a little bit, right? But you get assigned the S&P, you get assigned Coca-Cola, it doesn't have the same impact on your emotions, right? So this is just a very value-oriented trade. I've been bringing this one up on the channel for a while now. The expected move on Coca-Cola is 59.90 for the week. So let's go shopping for some Coca-Cola, see if we can find anything below $60. And Coca-Cola usually doesn't have that much volatility. You can see right here, at $60, you're getting 32 cents. I mean, the midpoint is more like 25 cents. This is just displaying the last traded price. But for me, it's between one of these two strikes, either $60, or if Coca-Cola with the rest of the market keeps pushing down a little bit, you could possibly even find the 59s. So for me, it's one of these two strikes, 60 or 59. Now, of course, guys, if Coca-Cola somehow has a minus 2% day on the Monday session, all right, and we come right down already into, 2% would already put us down into the 59 level. At that point, guys, you may even be able to try to find the $58 strike. So we want to be going as low as possible while still getting paid. I don't mind one of these three strikes, guys, 60, 59, 58. I think Coca-Cola is in a long form bottoming out process, almost to be completed shortly. This one has just been down with the rest of the value trade as a whole, right? The Dow Jones, the value ETFs as a whole, they've all been down because of the rising yields. But I think Coca-Cola has a better chance than most stocks of holding up the levels. It's got a lot of institutional investors inside of it, of course. So I do not mind buying this stock 60 down to 58. But of course, this is just my trade ideas. If you don't like the trade, then by all means, guys, you don't have to take it, right? So those were the top 5 options plays of the week. Now let's go through a ton of bonus plays. And the bonus plays, it's not that they're not as good as the top 5 options. It's just that the top 5 options for this week, I went with the highest quality companies, the ones with the most certainty. And the other ones that I'm going to show you right now, the bonus plays, they're a little bit more volatile. Still very good trade ideas, but either more volatile or the stock prices are just not ready yet. So I'm keeping them on the watch list. If they do come ready, I'm ready to strike, right? So number one is going to be Bitcoin, but we have to be a little bit careful with Bitcoin, guys. Why? Well, because Bitcoin is showing us a massive head and shoulders pattern on the daily, right? So we know that Bitcoin is in a very somewhat precarious situation right now. We know we do have support below us, 91.5 down to 87. That being said, guys, you cannot ignore this pattern. And if the SPY and the QQQ have a bad time in the month of January, Bitcoin's probably going to come down and test the mid 80s, right? So how do I want to play BITX? Is I want to wait for a big red day on Bitcoin and write way under the market. Talking down here, guys, mid 40s, 44 all the way down to roughly 38. Good thing that BITX has a ton of volatility, but these are the strikes. If Bitcoin has a bad day, this is 2 times leverage Bitcoin, so you got to be careful. I play this very conservatively and very far away. Matter of fact, let me show you the options chain real quick so you understand what I mean. You come too close, you get seduced by a ton of premium, right? I'm not going to trade this very close because I want to get the best level as possible and save a lot of my buying power. That being said, look how much premium we're getting at the 44s, guys. 1%. You can even go all the way down to $40 here and get 25 cents of premium, which is 0.5%. $40 on BITX would be a drop on BITX of roughly 24%. That would be a drop on Bitcoin of roughly 10 to 12%, right? And where would 10 to 12% put us on Bitcoin? Exactly where I think the maximum pain for this trade will stop, in the lower $80,000 range. So that is where I want to be playing on BITX myself. Another 2 times leverage play that I'm interested in is Tesla. Tesla 2 times leverage, right? Playing Tesla itself is fine. However, it does cost a lot of money to write short puts. You need like 40 grand, 38 grand, 35 grand to play short puts down there. That being said, the level that I like on Tesla is down here, 350 to 330. If Tesla has a red day, red starts the week, Monday and Tuesday, I'll be looking down here on Tesla. And on TSLL, that very same area of consolidation, 330, 350 on Tesla, is down here, low 20s, guys, 21.19, right? So you want to stay, look at the expected move for Tesla, and then you want to stay outside the expected move on this one. So let's say the expected move on Tesla is 6%. Well, the expected move on TSLL will be 2 times that. It'll be 12%, right? So you want to stay outside of that. So if I'm looking low 20s, guys, this will be a decline on TSLL of 23%. Tesla would need to go down 11.5%, 12% in 1 week for me to be assigned down here, and I want to be assigned down there. So for me, 20, 21, 19, as low as we can go while still getting compensated, I like this trade. Another trade opportunity that's not quite ready yet, in my opinion, is Apple. Apple with the very beautiful weekly breakout retest, right? And they are reacting from overhead resistance, but we know big tech in the markets can be weak this week as a whole. If Apple pulls back more, guys, 220, lower 220s is where I want to find some premium. I don't even need to look at the chain. There's no premium there right now. Trust me, it's too far away for Apple, right? But if Apple does come down into here for some which reason and loses this pattern and goes into some form of daily oversold conditions in the low 220s, 226, 225, I'll be looking down here at the 200-day EMA, 220, 215 as low as I can go. Same concept for Microsoft. I love Microsoft, but Microsoft has been a little bit weak, right? We try to do the breakout. Now if we get trapped back within the confines of this range and I can find some short puts on Microsoft, this one is more expensive. This one is a large account trade. For all of you out there that have a large account, I do not mind trading Microsoft, guys. 410 down to about 400 short puts down there interest me a lot. Just make sure you're getting 0.5% per week. Another trade in semiconductors, a volatile one, but one that's very cheap nevertheless, that you get a very wide margin of safety, is SMCI. Now, SMCI, you can say what you want about the company. They have the regulatory risk and all that. And I'm just looking to play this one because the company is very cheap and they should be having some very good earnings numbers in 2025 because we've heard from all the hyperscalers and all the semiconductor companies, and the AI data center infrastructure ramp is going to be booming. That being said, we do not need to play SMCI super close at all. The way the options chain is structured because of all the volatility, look how low you can get on SMCI while still getting a decent amount of premium, right? I don't want to be assigned SMCI too high. If I want to buy this company, I want to get it at the cheapest possible price that I can find, right? And for me on SMCI, that is as low as I can go here, 28 down to 23, the bottom end of the support range, guys. The support from all the way back here, 2023, before the exponential rally. So I want to be getting deep down in this location down there. And as you can see, when I pull up the premiums, right, you can get very good premium at a very low price. Take a look down here. 25s are paying 0.5%, 12, 13 cents. 25 on SMCI for 1 week, guys, that would be a decline of roughly 23%. Now, I know SMCI can move, but still, I wouldn't mind buying SMCI in 1 week at a 23.5% discount. I wouldn't mind that at all. That's just one trade idea. Same concept on SOXL. 3 times leverage of semiconductors. You want to keep it cheap. We're going to go all the way down here, low 20s, 24, 23, 22, bottom end of the support range on SOXL, all the way down here. If semiconductors are weak, I don't mind buying this one for the eventual rally, but I need to get the best price possible, 24 down to 23, guys. Not taking any chances this week. If I'm going to play these, I'm going to play these very, very cheap. Another one for a lot of you that want to try and pick the bottom of TLT. I'm not recommending it, but what you can do is start writing short puts below or at the October lows. Think for TLT, lower 80s, 80, 81, 79. If you're using TLT as a proxy, or TMF rather, as a proxy, this is the problem, right? We've now cut the October lows of 2023. TMF, you want to be going super, super cheap, guys, as low as you can go. You don't want to get trapped on 3 times leverage ETF on bonds when yields have not found a ceiling yet, right? So if we're playing TMF, you want to be going at least, above or below the expected move for TMF. So just go on this website bar chart, look at the expected move on TMF and try to go below there, right? Low 30s, guys, like 30, high 20s. Wouldn't mind it there, but it's a risky one. I'd rather play TLT, but then again, these don't move that often, right? Not my favorite trade, but for all of you who are looking to build a position, that's how you do it. You start writing short puts under the market, and that's how you build your position, right? Now, moving on to more, there's some recovery stocks that, although they have been crushed recently, are coming into some nice levels. One of them is Nike. Nike beginning destroyed. And I've been waiting for this flush for a while now, waiting for the $70 flush, guys. It is almost here. Now, I do agree Nike has its host of problems, but what they've done is they've acknowledged they've problems and they've set forth steps to try and fix them. That being said, below 70, guys, is below the 200 monthly moving average. I would not mind finally trying to make an attempt at building a position in Nike, but for that, I'm going to need better pricing. $68, $67, $66. I want the $70 flush. Why? Because I'll be getting better pricing than everybody since 2018. I want the $70 flush. I think the valuation down here is becoming okay. It's not cheap by any metric, but Nike, oversold conditions, one more little flush below 70, guys, and I think that's going to be the time for me to strike on Nike. As well, one stock that's not quite ready, but that I love a lot. This is a company that I do not talk about that often. I only bring it up when it's showing a pattern that I like, which is a monthly retest, breakout, retest, breakout, retest. Where are we going to retest? This is MasterCard, guys. MasterCard, another big account play. If MasterCard comes back down into the 12 EMA, guys, you tell me in the context of a bull market, is it a good idea buying MasterCard at the 12 EMA in the context of a bull market? This is COVID, by the way. Is it a good idea? Looks like it, right? So if we come back down, monthly consolidation after 4 or 5 months of beautiful rally, looking for the monthly higher low, I'm going to be sitting right there, guys. 480, lower 480s. I'm a big fan. That will be almost the 50 EMA. 50 EMA on the daily. You can see it's always been a good buying proposition. I made a lot of money taking this exact same trade back here. If they want to give it to us again, that'll be a very decent setup, guys. So MasterCard, 480s or lower. It's not quite ready yet, but a few more days or 1 more week of this, and it's definitely going to become in a more advantageous area for us. Another one is Palantir. So Palantir as well. Palantir, I do not mind playing this one, but let's be honest, it needs more consolidation, right? It needs some monthly higher lows. For me, Palantir, I'll be looking for options 55 down to 50. So it's not quite ready. It's coming down, but not quite enough for me. Another one like this is SoFi. SoFi, I like this one a lot. Matter of fact, I already have a position, but if we pull back down because of financials earnings into the lower 12s, think $12.50, $12, that's where I'm gonna be interested in SoFi. So as of right now at 14, not quite ready, but a few more red candles or another red week, that'll bring us down $12, even $11. This is the area I want for SoFi. Not that bad of a trade. Square as well, fintech play, but I did not put it on the top 5 because we have bank earnings this week. If we get a bounce on Square and then bank earnings are bad, CPI is bad, Square's going to come down to retest $80 or lower. I love Square, but I love Square as cheap as possible. And for me, that is below 80. Think 78 all the way down to roughly 75. That will be a very decent location, top end of the resistance zone right here. That is where I'm going to be looking to play Square. Another one as well is going to be Uber, but Uber is not ready yet. It was ready. I was telling you guys to play it back here. I loved playing it back here. I made some decent money in the process. If we give back the entire move and revisit $60, $58, I love Uber it down there for the valuation, but also because it's a very high quality company. So those are a lot of the bonus plays that I had to throw at you guys. Hopefully you were able to find some forms of ideas there. Notice the fact that I put a lot of emphasis on high quality companies, but when I am playing the more volatile names, 2 times leverage ETFs, 3 times leverage ETFs, or stuff like that, Bitcoin, I go very far away, guys, because I want the best possible pricing. We do not want to play too close, get trapped, and then the stocks run down another 5-10%, and you're trapped and you're out of money, right? So that's everything for today's video. Hopefully you guys enjoyed it. If you did, consider dropping a like. Sorry for the length of the video, but this is an important one, guys, because it's a very volatile market environment, right? I can make these videos if I wanted to in 10-15 minutes like other YouTubers. Just give you the plays and say, yeah, I like Palantir at 55, and that's it. No context, no explanation, just say, I'll be writing the Palantir 55 puts, and that's it, right? But I don't think that's going to teach you guys anything, right? If I just give you plays, give you levels, not much context behind them, just say, I like it. It's coming into support, right? What good does that do anybody? Probably nothing, right? So that's why I make these longer form videos to teach people how to run the strategy, the nuances with the strategy as well. So hopefully you guys enjoy that. If you did, consider dropping a like, would appreciate it. And also consider subscribing to the channel if you're new. Let's try and get me to 5,000 subscribers, guys. We're so close. If you haven't subscribed yet, consider giving me a little boost up to that 5,000 subscriber milestone. And lastly, guys, if you have any questions on the strategy, now is definitely the time leading into the volatility. Leave them down below and I'll be sure to help you out. And in the event you want all of these trades in real time, all of my own personal trades in real time, the wheel trades, but we do not only do short put trades, call options. Last week, we realized over $5,000 in call options and other short-term plays. If you want access to all the wheel trades, the short-term call options, the put credit spreads, the call debit spreads, the leaps, the share trades, anything, whether you have a small account, medium account, big account, I give it all. You can chat with me all throughout the day. Ask me your questions on your stocks, your options. We do private morning live streams Monday to Friday for about an hour or 2 where you see me trade live and ask me all your questions again. I share all my watch lists in the Discord, all the notes as well, and so much more, guys, that I don't have time to talk about. If that interests you, the link to the private trading group is down below in the Discord. That's it for me. Have a good week of trading in the markets, guys. I'll see you tomorrow. Take care and peace.